Welcome today to today's calls. You know, we all have these same challenges that we're facing, and we're all trying to figure out how do we facilitate a real estate transaction, yet protect ourselves, the consumer, and the industry. At the same time, we got to make happy clients so they refer us business, right? I remember in 2006 when the volume in real estate transaction is really similar to what we're experiencing today. And we have all often asked ourselves, or we get asked, you know, or what we are experiencing a bubble that's about to burst. And what happens when foreclosures hit the market, if they hit the market, and is now the time to buy? Those are the questions that consumers are Googling and asking that we need to know the answers to. I know my answers to those questions. And are we about to have a bubble that bursts? No, I don't believe so. But why? We won't get into that on the call today because we've got a lot of other information to cover. You know, what happens when foreclosures hit the market? I don't foresee that happening. We service our own loans. There's a lot of information and data that we have. People are in an equity position this time, unlike in the past. And we, as mortgage lenders, I don't know if any of you guys have tried to get a mortgage loan lately. It ain't easy. Whereas in 2006, 7, and before, it was pretty darn easy. So I think that we've learned a lot of lessons in the mortgage side of things. So I don't see foreclosures hitting the market, even though we had a percentage of people that filed for forbearance. They've got equity, they're okay. Plus, we put laws in place where they weren't negatively impacted in regards to their credit, like in the past. So we could have another conversation about all of that and why I feel the way I do and the stats to support that. But again, that's not why we're here on the call. I just want you to know what the consumer questions are so that you're prepared to answer those questions yourself. And then, is now the time to buy, or should I wait? Again, you guys are in the real estate market. You have those stats to answer those questions. But I do know that the best way for us to all be prepared to answer these questions is to continually educate ourselves. Teaching is something that I'm truly passionate about. It's why I have put together this outstanding panel that I'm excited to introduce you to today, so we can just work together to understand each other's perspective of these transactions. And that's why we have, I think, a really well-rounded panel today. Each one of the panels will explain how they see their role and explain the process, and kind of go over some of the like the new addendums that we are seeing with the contracts, the appraisal addendums. And then we're going to open it up for a lot of question and answers. My name is Michelle Castle. I'm with Guild Mortgage. I'm a coach and an area manager for the company, and I just love to teach, which is why you guys are all here. BJ is going to keep an eye on the chats for us. I will have this recorded, and we'll release that recording in my Facebook private group, and it will be on my YouTube channel, which is Michelle Castle. So it will probably be 24, 48 hours before you see that. Who I have with me today, and I am just calling everybody out based on how I see them on the screen. So I have Stacy Ochoa, which is our regional operations manager. She is my boss. She has been in the business for a long, long time, sees a ton of transactions, which is why I always go to her for problems, because she is like the queen of problem solving and just sees so many different transactions on a daily basis that nothing surprises her anymore these days. But she's been doing a ton of study on the collateral underwriting and some of the ways that we can work together to get through some of the challenges that we're experiencing in regards to collateral underwriting. She'll explain what it is, how it's used in the mortgage process, and how that relates to your appraisal itself. And then I have Casey Rivas, a good friend of mine who is a real estate attorney. So you guys, if you're in Texas or Oklahoma and need any advice or help on the legal side, she is thebomb.com. And we're going to talk just briefly about the appraisal addendum, and she's going to cover some of that for us. And then I have Randall Horner somewhere on the call. He is actually on vacation this week, but joining us on a call. He's my underwriting manager. So he's the one I beg and plead to when I don't get the answers I want from the underwriter. Sometimes he and I agree, sometimes we don't agree, but that's okay. We still love each other. And then we have Chris Green on the call. He's actually behind us hiding. What did you say about yourself a while ago?
The show pony has arrived.
Oh yeah, he's our show pony today. So come over here so they can see him. So Chris also enjoys educating, which is why I asked him to join us. Not all appraisers are okay talking to people.
No.
Usually they like properties and numbers and reports and statistics and all of that stuff that I don't like. So it makes us good partners.
Yeah, we work out pretty well.
So, but Chris does like educating. And so I asked him to join us today so that you guys understand from the appraisal's perspective. Y'all all excited? All right. So just a little bit of the process from a loan officer's point of view. Of course, I have preached the difference in a pre-qualification versus a pre-approval. A pre-approval means that we've received the paperwork, we have run all of the analysis, and we know that we're good to go and conform to the loan program guidelines that are being presented. Now, you guys know loan program guidelines are different for different on the property as well as the customer. I mean, the guidelines are just different for each agency. And so part of that whole pre-approval process is to have a really good communication between us, the lender, and when I say us, I mean industry, and you as the realtor, because you've got your eyeballs on the property. So that two-way communication during that pre-approval process is super important. The other thing that's really important from a loan officer's point of view, when we are pre-approving someone, remember, we're doing this based on debt to income. Part of that debt to income process is knowing and understanding it's debt to income and the assets. Right now, more than ever, the asset part of it is very important in the pre-approval process. Because if the buyer is having to pay over list price for the house, what is the house going to appraise for? And how much of a check are they going to have to write? Do they have the funds in the bank to write that check? And if they wrote that check, do they have enough reserves to still qualify for the house? You guys are looking at 4 or 5 houses this weekend. Is the customer pre-approved and ready to go? I don't know. What's the house going to appraise for? And how much money are they going to need? How much over list price are you going to have to pay in order to get the contract? Pre-approvals used to be pretty easy for us because we were just looking at debt to income and assets. Now we have a lot of information that I don't know the answer to, and neither do you. So the more you understand how to accurately look at your CMA and figure what you think the house might appraise for, the more accurate your pre-approval letter is. All right. A lot of pressure on you, a lot of pressure on us to make sure that the buyer is qualified to purchase that property and pay what they have to pay to get under contract. Let me give you just a tool that we use to help us run these scenarios with the customer. And I'm going to share screen in just a minute. The one thing that I have that Casey's going to talk about in just a few minutes, part of this whole process, again, is what's the house going to appraise for and how much are they going to have to pay for it, knowing that we're guessing on all of this. But we need to be as accurate as we can so that we know that people really can't afford to buy the house. But the other piece of this is the buyer understanding that they literally have to write a check for the difference. And it is surprising to me how many consumers don't realize that. One of the tools that we use to help us show the customer what to expect out of pocket is what we call, we've we call this the appraisal gap because there is a gap in the sales price versus the appraised value. Beginning of the process, remember, we're all just best guessing. But we put in there, okay, what if this house that you've got to pay $250 for only appraises for $240? Now, what does that do? And how does that change how much you're going to need for closing? If they're strapped money-wise and they can't pay any more than that amount of, the 50, in this case, they would be $55,000 out of pocket on a $250 sales price. If the house only appraises for $240, now what? You guys, as a realtor, said, hey, we're going to have to pay $250, but I think the house probably appraises for more like $240. So we're going to go ahead and run those scenarios up front and have that conversation. So in that case, if all they had was $55,000 to work with, because not everybody's got an unlimited amount of funds and they can write a check for whatever they want, we have a budget to live in. We also have debt to income ratios that we have to worry about too. So in that scenario, we would look at maybe doing a 240 sales appraised value and do upfront mortgage insurance, because now they don't have 20% because the house didn't appraise for $250, the sales price, and all they had was that $55. So we would back down the amount of money going towards the down payment, so they have the cash to pay for the gap in the appraised value and the sales price, but now they got mortgage insurance. So if we're fighting debt to income, we might choose to do the mortgage insurance paid up front. That way their payment doesn't go up to include that mortgage insurance. Or they may choose, instead of doing that, looking at doing it as a monthly payment for the mortgage insurance. And then what does that do to the monthly payment? But I just wanted to show you guys as an example of the scenarios. Number one, this is why we don't do 15-minute willy-nilly pre-approval letters, because we've got to thoroughly analyze the file itself and make sure the customer is pre-approved to go buy a house. Then we have to run all of these different scenarios to make sure they're going to be okay. And then whenever you guys do find a house, we're asking you that question. All right, they have to pay $250 for the house, but the list price was $245. What do you really think the house is going to appraise for, so we can run those numbers and have them prepared prior to going under contract? Does that make sense? Does anybody have any questions in regards to that before I turn it over to Casey, so we can just really talk about that appraisal addendum? Because how you guys complete the contract and how you complete the appraisal addendum has to match how the lender pre-approved the customer. If you as a seller's agent are not looking at that appraisal addendum and calling the lender and saying, hey, lender, have you already ran these scenarios matching the appraisal addendum for the contract I just received? Then that pre-approval letter you're looking at may not be valid. Please, 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 on the buyer side and the seller side, pick up the phone, call the lender, have these conversations, because it's more important now more than ever to have a relationship with the lender you can have these conversations with and make sure all of these different scenarios have been ran to make sure the buyer really can get to the finish line. And it doesn't matter if you're on the buyer side or the seller side, these are the conversations that you need to be talking. So Casey, briefly, I know you got to get off the call in 15 minutes. Talk to us a little about the three options that we're seeing on the appraisal addendums.
So good morning. Are there any realtors on the call? I guess I didn't know.
Yeah, there's probably,
okay.
It's half and half. No, I bet it's probably 75% realtors.
Okay. So I'm looking at the, and I didn't think to put it up on my screen, but here you go. It's that TREC addendum for the appraisal addendum that you guys are talking about. Now, my first comment on this, and what I pointed out to the last group, was this only applies to, technically, only applies to the third-party financing addendum. So legally, in my world, I would claim this doesn't apply to cash buys. I don't know, there have been no court hearings, there have been no court cases, there have been no decisions, no statutes, no regulations whatsoever passed down on this. Trust me, I've looked. But technically it would not apply to VA or cash out buys. So basically this form, if you use the form, which I'm hearing it's being used a lot right now in this market, there are three options. The first is basically your buyer's going to pay no matter what, how the appraisal comes in, they're going to pay the cash. They've waived all rights. It doesn't matter how the appraisal comes in, they're going to pay the difference no matter what. The second one, well, let me skip to the third one. The third one is kind of the opposite. The third one says you have to provide me the appraisal, and then I have so many days to decide if I'm going to terminate. So basically, if their lender says, no, the appraisal came in too high, they have that right to terminate. The second one is the one I'm hearing is being used. And this is the one that is a combo. So it's a partial waiver. It allows your buyer to set a maximum that they're going to pay. So now what that number is difficult to determine. And that's kind of what I'm seeing is the issue. It becomes the realtor and the buyer trying to figure out what should that number be. And I've heard that number should just be the asking price. That the appraisal should appraise at least for asking price. But in this market, that's probably not realistic sometimes. So, and that you take a chance on the seller, if I were the seller in that case, and then I don't know that I would agree to this. I think the appraisal, if I were the seller, I would want the appraisal to appraise for higher than asking. Then again, your buyer may say, I don't care, I've got 50,000 extra cash. So let's say we can go 50,000 over. Here's the most I can give. And that's probably what I see is probably happening the most, is that they want them to put that maximum amount in that blank, just to make sure they get the home. They don't want to take a chance on losing the house. So they're putting the max that they can afford in there. And I understand that philosophy. My caution on that to the realtors and to everyone on the call really, and where my concerns start to pop up is I start to have flashbacks to 2008. And I start to see people buying homes they can't afford. And so that starts to give me concern in this market. And this is a crazy market. And pretty much every one of these contracts is being signed under duress. And duress is a contract defense under the law. These people, this is the 16th house they tried to buy. They keep getting outbid. They're in a panic. They submit the offer the day they look at it, in an hour. Some of them are just submitting it sight unseen, because they're just desperate. And they're signing these contracts out of desperation, and they're signing these addendums out of desperation. So my caution to everyone and I know realtors don't often have access to the finances. They may not know the finances of their buyer. But if you do, and if you know your buyer is getting out of their league and cannot afford this home, you do have a duty to speak up. So you are licensed individuals, or you're the fiduciary duty to say, I understand you want this home, but can you really afford this? And what's it going to do if you can't? Because they are contractually bound to whatever number they put in here. In reality, in this market, no one's going to sue for specific performance because they can just put their house right back on the market and sell it to the next person. But it doesn't mean that they're not contractually obligated to match this number. So that's my caution on the addendum. I guess I didn't realize there was so many questions on it. And so evidently there were, and I'm happy to help anyone who is cautious to use this form or doesn't know how to use this form, because it is basically, the realtor and the buyer trying to sit down and figure out between themselves. And sometimes that's a scary thing to commit your client to. So.
Yeah, since Casey's got to leave, rather than hold the questions until the end, does anybody have any questions? If so, raise your hand and then I can call on you because I can look at
and hey, Michelle.
Yeah.
I texted you earlier, but you didn't get it. My 10:30 was canceled.
Oh.
So I can stay on. If you want to do questions at the end, I'm happy to stay on.
Well, we'll go ahead and take questions now. I think that then you don't have, unless you're just curious about how all of this works and want to be on the call.
Okay.
Does anybody have any questions in regards to the appraisal addendum and any liability concerns that you have?
Well,
yes, Erica.
Hello, can you hear me?
Yes, ma'am.
Hi, thank you. So this is for either you, Michelle, or Casey. So as far as a VA buyer, can you tell me what protection? I know there's the clause that they can sign, the escape clause. So what protection does that give a VA buyer when they're trying to, win the offer? They want to do the appraisal waiver. Can you explain to me what that protection is for them?
Go
It,
ahead.
well, I'll answer it from a lender's perspective, and then Stacy, if you have any thing to add on that. The FHA addendum, and which is also the same as the VA addendum, it's all on the same form, and I can't remember the HUD number. But anyway, it says that the consumer does not have to proceed with the transaction if the house doesn't appraise, basically.
Mhm.
It does not say that that in no way can they can choose to, which then you would revert to the appraisal addendum as to what their choice is in regards to the event, the house does not appraise for the sales price.
Okay, that makes sense.
And then it just goes back to, from a lender's point of view, it just goes back to whether or not the veteran can afford and whether we can get their loan done based on them having to write the check out of their reserves.
Okay.
And that's the sticking point for us, is because the consumer's entering into a contract stating that they're committed to pay X number of dollars. This is why it's so important that you fill out that appraisal addendum and have a pretty good idea. But Casey's in the process of writing another, what would you call that, Casey? A form that would go with the contract?
Yeah, so I was just about to address that, because I don't know if other people have seen this, but it's basically a special provisions addendum. So it's not a TREC form. It's being drafted basically as a way around using the TREC form. Now, I don't know how the two are going to interact. Like I said, there's no rulings on this. There's no guidelines for you guys at all, and I hate that. But it's a form that's being circulated that actually allows. It's a separate contract, is what it is. It forms another contract between the buyer and seller, and it allows a high and low to be set. I like the form because to me it provides more security to both parties. Your buyer knows exactly how much the maximum is going to have to pay, and your seller knows the minimum they're going to have to take. And so it sets a high and low. And so both parties go in with a lot more clarity as to what the numbers could be at the end. But it is a separate contract. I drafted one on my letterhead for a local real estate office here to start using. There's some questions on it and how we're actually going to implement it. But if you see one of these pop up, that's what it is. It actually provides more flexibility between the buyer and the seller. And because it is a separate contract, they both sign it, and in the legal world, it becomes its own document. It is upholdable. I don't know how the lenders are going to respond to that. I don't know how TREC is going to respond to that. We don't know. But in my world, it's binding and it works.
What I love about the form, and I saw a draft of it, is it sets the if this, then that. So we can have those conversations and make sure that people are comfortable with number one, that they qualify. Number two, that they're comfortable with the terms, even in a worst case scenario. It's all spelled out. Norman is saying that you are not supposed to be using the appraisal addendum on government loans. So I am not here to tell you guys what you can or can't do from a legal standpoint. You need to consult with your broker and also legal counsel if you have any of those questions. So I'm just speaking from a lender's point of view. What I will say from a lender's point of view is if you check any of those boxes, or there's any reference to any contracts outside of the TREC contract, the lender will need to see a copy of it. So if you have it, and the appraiser is going to want to see a copy of that too, because it's all part of that transaction. That's what I'll state from a lender's point of view. Stacy, am I missing anything or misspeaking on any of that?
No, I think one thing that I'd like to note is on the amendatory clause and the escape clause for VA, we are having a large number of sellers not wanting to sign those because we, of course, normally put in the sales price on those addendums saying that they have to appraise for that sales price. So they don't want to sign it. And I think, maybe that agreed amount that Casey was talking about needs to be put on those addendums instead of the sales price, that it must appraise for this amount. And that every party knows, you know, that if it appraises for this amount, they're going to move forward. And the seller or the buyers have to pay the difference. So, I mean, it is a form that has to be signed by all parties. But we are having a difficult time getting those sellers to sign that.
And I know I've had people call me and say, hey, can these sellers say they won't take VA loans? And I'm seeing that too. And that's probably one of the reasons is that, well, the time periods, how long it takes to get them processed. And then they just do have all these clauses that really aren't friendly in this market. And,
Right.
and you know, you're absolutely right. That's why I said this truck form is not supposed to be used for, the addendum is not supposed to be used for the FHA or VA financing. I think it is being used across the board. But like I said, my rebuttal to that would be, well, this is the wrong form. It doesn't apply. It's null and void. So that's my caution on that. Especially if I were a cash buyer, I would say, well, I signed it, but that form doesn't apply to me. You use the wrong form. If I wanted to get out of it, you know, so I have that caution out there. I don't think any buyer is going to try and back out in this market, but you never know.
Hey, Casey, would you put in the chat your contact information for anybody that has any follow-up questions? Because I think that this does beg for some more one-on-one conversation. And then what I was hearing you guys say is maybe some additional documentation like that form that you have on these government transactions where there is more of a seller comfort that there is a ceiling, there is a floor, and the veteran is qualified to move forward based on these terms would help our veterans secure contracts on these properties. Because the unfortunate truth is that oftentimes those VA and FHA contracts get discriminated against. I mean, that's just the reality.
Yeah,
unfortunately.
And I don't know that the VA, should it come down to push or shove, I mean, the VA probably would not allow their buyer to be subject to this. I mean, in reality, they'd say no, you know, they have all that power. But this does provide, if your veteran really does have the cash, it would provide your seller security, and it would help them to move on forward with the loan. So yes, I'm happy to put my contact information in there.
And Dick is asking where we can get the form for the appraisal addendum. That's a TREC form.
Mm-hmm. So the TREC one with the three options is a TREC form, and I apologize, I don't know the number.
And then Casey's got one in addition to that she's got drafted. So again, this is something that you guys should be discussing with legal counsel and your broker. Don't say because Michelle said, please. All right, so thank you so much for covering that. And if you guys have any other questions, let me make sure that there wasn't any other hands raised real quick, and then we'll move on. All right, we're good. All right, so also on this call, I have Chris as an appraiser. So you guys, just so you understand the loan process side of things, once we have a contract and we disclose the loan based on the terms of the contract, the customer signs the contract itself, and there is a form in there that is the intent to proceed that has to be executed before we can order an appraisal. Now, I can't speak for other lenders, but I can tell you what our process is. The first thing we order when we have the intent to proceed, well, first we collect money because these appraisals are expensive, and I don't want a collection of appraisals on transactions that I had to pay for that doesn't go through because people are mad that it didn't appraise. So the first thing we do is collect money. Please know and understand that the amount of money that we're having to collect right now is we don't know, because we don't know what it's going to take to entice the appraiser to take an order from us. I will tell you that we have great relationships with appraisers as a company. We pay our bills. Appraisers typically like us because we don't harass them for a bunch of additional information afterwards, because we have good appraisals, that appraisers who know how to do appraisals. So typically, getting the appraisal accepted is not a challenge for us. However, it has become a lot more expensive than it used to be. And again, it's supply and demand. A 2x4 costs a lot more now too. So, so we collect the fund, we have the intent to proceed, we collect the funds, we order the appraisal. I mean, we're trying to get the appraisal ordered as quickly as possible because we know that it takes time to get the appraisals done. There's a couple of things that are a little bit different in our mortgage world that used to, oh, Michelle had her hand up. I'll come back around to Michelle's hand in just a second. But there's a couple of things that are a little bit different in our lending world. Number one, there's so much data that's been collected over time. We love the data and the algorithms put in place then all of this data in collateral underwriting determines that we don't need an appraisal, that the system is okay with the value that's stated. Now, so there's some times that we aren't going to need that appraisal, but guess when we're going to find that out? After you're under contract. So we still need your help in determining what you think the house is going to appraise for. We can put that stated value into the system and run it and see if the system accepts that value as is. If it does, then we don't need an appraisal. The buyer can sign an appraisal waiver, waiving their rights to an appraisal. There's another, there's a hybrid now that is this still in beta or is it full? Is it out for everybody, Stacy?
It is still in testing.
Okay.
Maybe.
Can we talk about that? I mean, we can, it's not a secret, right?
Well, it's not a secret, surely, because it's going, I mean, we are doing appraisal.
All right. We have secrets because, you know, Fannie and Freddie really like us and throw us into testings all the time. This one's not a secret, so I can tell you. We have Freddie Mac has come out with a beta, with a hybrid appraisal in which the appraisers aren't having to go into the property to take pictures. They're actually sending photographers out to do video of the property. Am I misspeaking, Stacy?
No, it's a 3D video. It is really cool.
So, and then the comp pictures are the MLS pictures that are used on the appraisal. And then there is, then it's a remote appraisal process at that point. And what that's done for both of those two things have helped us speed up the turn time for appraisals. But again, we're not going to know whether or not those options are available to us until after we have a contract and we are setting the loan up. If those two options are available, we discuss those options with the buyer and they choose whether or not they'd like to proceed with those options. And if they do, then we're not waiting 2 to 3 weeks to get an appraisal and we're not having to spend the money for the appraisal and we are not having to wait for the appraisal to find out how the transaction is going to transpire. If we do have to order an appraisal, then we're waiting the 2 to 3 weeks. In the meantime, we're getting our loan. We as a Guild Mortgage in our branch, and I'm sure it's the same in all branches, are getting the loan fully approved and just waiting on the appraisal to wrap the loan up. The unfortunate part of this whole process is that the appraisal comes at the very end because of turn times. So you guys have been under contract for 3 weeks. We finally get the appraisal. Looks like the value is okay. Looks like that we are not going to need any repairs because maybe the appraisal was complete as is. And then we send that appraisal through the collateral underwriting engine and we find out there might be a problem with the comps that were used in the appraisal. We can't prevent it. I am a big fan of preventing any problems that you can, which is why we're all here today, because what can we do to work together to make this a better, seamless process? But the unfortunate part is the appraisal gets to us at the very end of the process. So if there's any problems, it's at the end of the process. But what I wanted Chris to explain to us really, when he gets an order, what does he do? How does he determine what is a comp and what is not a comp, and how that might change once he goes to the property? Because well, I'm just going to let him speak because I'm not going to tell you how he does his job.
Hey,
Although I'm bossy like that, I probably would try. So I'm turning it over to Chris Green.
All right, thank you, Michelle. The comp process right now. Sorry about that. It's super challenging, to be honest with you. I've been doing this for 5 years down here. And before that, I was appraising in Iowa. I actually had lunch with the gentleman yesterday. He's been doing this since 1976 was when he got licensed. And this is just a super challenging time. As far as like when I go out and look at a property or
Well, wait, back up.
yeah, let me back up.
Okay,
Yeah.
you receive an order from a mortgage company. The orders, for those of you guys who are, don't understand what goes on behind the scenes, we place an order with the third-party company. The third-party company then basically sends the order out, and Stacy will tell me if I'm saying this wrong. The third-party company then really dispatches the appraiser. The appraiser has just a very short period of time to accept the order or decline the order before the order goes to the next appraiser that is on the list. So the order comes in. Now, when they accept the order, they're also seeing how much the mortgage company is willing to pay, which is why we've had to increase the amount of money that we are offering on these appraisals to get the appraisers to take our orders, because money talks. We can't bribe them for appraisals for value, but we can use the pricing system to see. I mean, they'll determine if it's worth their time. You guys remember, in our area, sometimes those appraisers, whenever they pick up an order, means that they're going to be on the road and driving quite a distance, not just for the subject properties, but the comps too. So they're making those determinations whenever they get that order coming across their desk, right, Chris?
Yes, ma'am.
So, you know, if they were receiving an order for Trenton, Texas, and they've got a bunch of orders over in Plano right now, Trenton is quite a distance, so they might decline that order, or they may look at it and go, well, for the amount of money that they're paying me, it's worth my time and my gas to go do that order. So that's just kind of from a business standpoint, their thought process. And then you get the order, and then what?
Yeah, so a couple things, just so like, just to share like how our business model works is we're actually, like with my firm, WP Appraisers, we're a team of appraisers. So like right now, there's a lot of like mom and pop shops out there. And I know you guys like, I mean, you send the order, you're getting crazy long lead times and some ridiculous fees. Right now we have about, how we do it is we have someone, we call it the air traffic controller role, where we have tons of email and bid requests that come through. Right now, my team, we've got 7 appraisers, not including myself, and we're doing about 110, 120 appraisals a week. So we are extremely busy, but how that process works, it comes across our desk. We have someone fully dedicated to looking at what that bid looks like. Now, for example, like we don't,
Get closer.
we prefer, can I just?
Yeah. Yes.
We prefer not to work.
We're gonna get closer.
Okay, we prefer not to work with AMCs. We'll do it like if we're partnering with a lender.
Go that way. My mic, that mic is a shotgun mic,
Okay.
but since you're taller than I am, sit down. I bet you'll be fine.
Okay. All right,
Can
there we
y'all-
go.
Can y'all hear better? Speak.
Okay, I can speak. What'll happen is that order will come across our desk. We have an air traffic controller, as we call him. Really, we've got two types of way we get our orders. One is through like a third-party platform, which would be like your Mercury, Guild. You guys use a lot through Mercury. So I work with like, Bob Fellows, and we figure out how to get those orders across. We love using those types of platforms because it gives us the flexibility to assign it to the appraiser that has capacity, also allocate it based on location, so it doesn't jam you guys up, so you can close the deal and move on. We try to be the most easy part of the process, which is challenging right now. As far as like who we partner with, we're more of a boutique firm, so we don't necessarily we're not like an appraisal sweatshop. We don't take anything from everybody. Like we have certain clients that we partner with, so whether it's a cupcake or whether it's a turd, I mean, we'll take the order. We will price it accordingly, but we have our set fee. And then if there's additional complexity, obviously, if it's like on 20 acres or something that's a little funky, we'll price it accordingly just for the extra man hours.
Or like this example right here where you
Oh,
gotta
what do we got?
a
I'm
duplex, no comps.
Oh,
Typical
good.
for the area, not currently leased,
Oh, yeah. So we'll, so when
Is
we,
that a turd? Is that what you would consider? Or it's
it can
just
be interesting. Turds to me are $500,000 manufactured homes on, yeah, there's more turds than that. So that can be done. For us, it's really knowing the client that we're partnering with and the underwriting. Obviously, my team, everything we do is going to be USPAP compliant. It's going to have the proper signatures. We're going to be above board on everything. However, we really do go to the mat to create a, like for example, on that, like the duplex, full duplex. I bet you it's out in the sticks.
Yeah,
If
she's
there's,
from this area, so it's gonna be around
oh
here.
yeah. So we had one, it was in Princeton, I think, and it was like one of the only newer duplexes in Princeton. We actually went out 25 miles to find something that was even comparable. We kept our underwriting team, that we were partnering with at the time, in the loop along the whole way, and just said it. And when we bid it too, like we don't just take it based on price and turn time. Like it's, hey, is this something that can be appraised? Is it something where I can create a defendable, credible report? And if so, we'll partner with you guys. So on something like that, and I'm just going based on the one we just did, we went out, I think it was like 25 miles. We found great comparable sales. Granted, it's in a different area. Some of them weren't as recent. So one thing I'm noticing is we're doing like massive time adjustments to create that credible and defendable report. But to answer that question, yeah, we could, we would do, we would definitely, we want to be like a yes solution for the people we partner with. It's just sometimes like, hey, this is what it'll cost based on those complexities and turn times. But Michelle, like the question you asked, so the order comes across our table. The air traffic controller has it. We know at any given time, so my team is running about a 1 week to 2 week capacity. If we get past 2 weeks, it just doesn't work out for us and it doesn't work for our partners. So we just pass because once we get jammed up, it just let someone else take a swing at it. I can't speak for other firms, but that's just, if we give our partners a yes, then I mean, one of our houses will be burning down before we miss like a turn time.
So here's the challenge I think that we're talking about. Well, there's a lot of challenges,
Yes.
but the seller's agent had put together a list price based on a CMA.
Yes.
The buyer's agent makes an offer based on a CMA.
Yes.
And we're setting expectations based on all of this information and a lot of assumptions. You get the order. When you're looking at the order, how are you determining what would be a good comp to use? And then what is the process? You guys are doing the desk work and you're looking at comps, and then you're also going out to the property and probably come back. And then after you come back to your desk, your comps might change because of the condition of the property or whatever, because we've got condition and quality that you're looking at.
Yep.
So kind of walk through how you're selecting the comps and what we can do as an industry, as a group of realtors, to understand your thought process. And then Stacy and Randy will cover it from a collateral underwrites algorithms, because even after an appraiser turns in an appraisal with their comps are graded to other peer comps that were turned in the same comps by their peers for similar properties in the neighborhood. And they're graded, the appraisal is graded based on that data and algorithms. So even after the home is appraised, there is still another layer that you guys probably are unaware of, and a layer that we are seeing become more of a challenge than it had been in the past, because the market's just moving so quickly. So the other thing, the part two to this that I wanted Chris to cover with you guys is how, as an appraiser, he's determining what the age, or what I call appreciation adjustment, which isn't really the right word, how he's determining what that adjustment would be for those comps that were selected. Will you cover that?
Oh, I will do my best.
Okay.
So right now, everything is, it just looks different than what it did a year ago. But that being said, When the order comes across, just because it's such a sensitive market right now, our air traffic controller, we are sometimes pulling pre-comps to see, like, for example, if this is unique property, historic home, downtown McKinney, selling for, 1.4 million, something that's like not going to be your normal cookie cutter, we will pull comps to see what we're getting into beforehand. And if this is something where we can produce a credible report. When we are on site, we are also looking for, we do our normal inspection like we would always do. Really, when we get back to the office, it's kind of like when the magic happens. We're looking for what has sold, like obviously is something sold like across the street, is something sold, a block over, what does that neighborhood in its entirety look at? And then as I'm coaching my team, we're putting additional search parameter, additional kind of filters on that. What is sold in the last 90 days? What's sold in the last 60 days? What's sold in the last 30 days? I'm actually looking for comps where a lot of the times when I create a report, like for example, it comes across our desk, it sells for over asking price, whatever the list price was. Are the comps I'm using, can I present comparable sales that also sold for 40, 50, 60K over asking price? Now, granted, I'm talking about kind of, where I'm playing in, we're based in Frisco. So it is super challenging right now. So I'm looking at marrying a bunch of different ideas like, hey, is this something that I can show that has sold for over asking price and sold for, in one day? I'm having conversations with realtors, even with some of the comps that I'm pulling, like, hey, and I'm putting that information in the report. We're like, hey, I know on this property, they did a first round, they had 100, for example, a Frisco deal we did. The first round, they had over 100 offers within 48 hours. The realtor swung back and said, hey, if the offer is anything less than 100,000, if it's anything less under 100,000 over what we have it for, you won't make the second round. They went to the second round, they got 22 offers.
So Chris.
Wild. And that's what we're dealing with. So it's like, when I get into the office, every day I'm just like, what are we going to do today? Because you're just like, I am seeing more unique circumstances, which is fun because it challenges the team. And, like, hey, these are just what we're playing with. And then the collateral underwriter aspect of it. I am like, you talk about like what my peers, like we are on a tightrope. Like everything we do is so scrutinized right now that I've coached. So like we're doing over 100 a week. Anytime any one of my team members, like if we're not going to make contract price or something, I have 2, if not 3 other appraisers putting their eyes on it, making phone calls, trying to figure out, are we missing anything? Because the reality is like people are going to be disappointed, but my job is not to make people happy. That's your boyfriend, girlfriend, spouse, whatever you got. Like my job is to create a credible report and protect my firm. That being said, we value our relationships. So like, if I have someone, because sometimes I'll get on the phone with a realtor after I got approval from the lending officer that I can have that conversation, or the underwriter that can have that conversation and just walk them through the process. Some of the conversations I have are even like, I hope I'm wrong. I hope you have a money comp because I will be the first one to put it in there. But like, I want to make sure that I've exhausted all resources and all avenues where, if it's not going to make value at the end of the day, I did everything I possibly could. I know not every appraiser is like that. I'm just speaking for our firm, but collateral underwriter, that's the other curveball you get.
Yeah. So here's what, and I'm going to get closer so you guys can hear. So this is why that partnership, number one, is so important, and that there's open lines of communication. Now, my question to Chris is, what if you show up at the listing and there's information for that scenario where that at the house across the street, this was the structure in which the whole bidding process took place, and it was just a buyer frenzy, and maybe 2 or 3 houses in the neighborhood had similar situations? Wouldn't it be helpful if you had that information in a packet at the home so you understood all of that, and then all you had to do is validate the story?
Yeah, for sure. Like, so again, I can't speak for, let me back up. I will always create a credible report. I will never, even anybody in our office, it's all about quality. Nothing leaves our desk that like you wouldn't be okay going in front of board and defending. That being said, some of the best information I get is from realtors. So like I'm now if you give me a packet of like, hey, here's a comp that, you know, they're asking this much. I mean, obviously everything we do goes off of sales price. So has it sold? Hey, was it even a sale that hasn't listed? And can I get the closing documents where I can verify that? I will even use that. So to Michelle's point, yes, some of the best information we get, because it just helps me produce a more credible report and it helps me protect my team. But all that information, I'm not going to say I'm going to use it or not, but if it helps us produce a credible report, I always use it.
Okay, so let me then just tell you, so in this situation, the collateral underwrite is a report. The SSR and the CU is a report with algorithms built in with a national database full of data.
Mm-hmm.
And just like loan approvals, not everything is cookie cutter. When it's not cookie cutter, we as a lender, depending on how the CU rating is, determines whether or not Fannie or Freddie is going to audit the file and tell us whether or not they'll purchase the loan.
Yep.
If we have to go out on a limb because we don't have a cookie cutter appraisal, the only way, Randy's on this call and he's going to nod his head, that we can go out on a limb is great information from the appraiser explaining why it's not cookie cutter and statistics to back it up.
Yep.
It's just not an opinion. It's not based on emotions. It's based on numbers and facts. Because there is some appraiser discretion, there is some underwriting discretion that is built into every one of these loans. But for the most part, it is data that is provided. So if we're going to go out on a limb, we have to, I love what Chris is saying, a credible report. It is really important that the lender have that trust and respect for the appraiser that is providing the appraisal, because sometimes we have to go on a limb and that information is super important.
Yeah.
Randy, do you want to explain, or Stacy, which one of you guys want to explain the collateral underwrite part of this? Yay!
All right.
Randy's volunteering.
Take her.
Take it.
Okay. I'm just checking. Am I off mute? Can everyone hear me?
Yes, sir.
Awesome. Thank you for giving me the floor. So I think everyone understands we're introducing the CU, and I'll just kind of give you some background to it and what we run into. The lack of inventory is skyrocketing.
Yeah.
The prices that these homes are having to sell for. It does take time for collateral underwriter to catch up to these trends because it's based off of averages from the past. So, but what we run into is, and this is probably more for Chris, and he can explain more, is collateral underwriter will say, okay, you provided me an appraisal. Your adjustments to the comps do not meet what we think it should have met. I'll give you guys an example. So let's say the home is selling for over sales price. So, you know, Chris is going to go try to find the comps to try to meet us in the middle, give us a quality report that will minimize the amount of money that the borrower has to come out of pocket for. I think that's everybody's goal here. But what they'll do is they'll go find homes that have sold for that high. And what I'll tell you, the biggest thing is GLA. I think if I can paint a picture here. If I said that the average price per square foot, especially in the realtor world, if I said it was $100 a square foot, you'd probably say that's probably conservative. For a home to be sold that they're selling about $100 a square foot. But what we're seeing is when the appraisals come in and the adjustments come in to the comps, they're adjusting them at, like, and this is not an exaggeration, $20 a square foot.
Yeah, that's light, but yeah.
So what that does is, as an underwriter, we know that that's not realistic. Like, that number has been kept small so that your appraised value will remain high. It's kind of the reverse logic. So like when we go back to the appraisers, because collateral has, now that it's flags from collateral, I have to respond to the collateral. Like, I have to tell them, why is the square foot adjustment $20 a square foot when the the past appraisals in the past have shown it to be over $100 a square foot. And I'll be honest, and I'm seeing this a lot, is appraisers don't really like to be questioned. And so what you'll get is very much well, that's just what it is. Well, as you can imagine in my role,
Yeah.
I can't respond to collateral underwriter that way. When really and truthfully, it's probably a better time adjustment. You know, hey, this home sold in February, it's May, the market is way different.
Yeah.
Like if that was the adjustment made to the appraisals, we could fly through collateral underwriter with really, that's an easy explanation that I can give them. Or another one is they'll tell me like, hey, this home, my comp has 3 bathrooms, but my subject home has 2 bathrooms. Well, that's worth $1,000. Come on. I mean, like, I'm using this as an example, but you see these, like they're saying, hey, a buyer looking at your home and a buyer looking at the same comp would only pay $1,000 for an extra bathroom. That's not really true.
Yeah.
And so when we challenge the appraisers, it's not so much of a challenge, but we've got to respond to the historical data that's presented to us. And that's really what you run into from a collateral underwriter perspective. And, obviously we don't just deal with Chris, we deal with many appraisers, but I think everyone can attest that they don't like to be questioned, and they certainly don't want to defend their adjustments. And so we're at basically this, we're having to do a battle that I wish we didn't have to do.
Yep.
So
Let me remind you guys, we receive the appraisal 2 to 3 weeks after you write a contract. We're down now to closing date. The appraisal is reviewed by the underwriter and ran through collateral review, because we can't do it until we get the appraisal.
Yeah.
So we have the appraisal, we run it through collateral review, and now we have to defend the rating. And it's a 1 through 5. And if it's a 5, it's going to get audited. If it's a 4, it's likely to get audited. So we have to defend the appraisal. Remember, we're now 2 to 3 days before closing.
Yes. And so I guess my question for everyone is like, obviously it's a larger thing than just us, but like, what would be the best way for me as an underwriter to get this loan across the finish line if I'm running into these obstacles? Specifically GLA, because I would say that that's pretty rampant right now.
Yeah, for sure. So again, I can just speak for my firm. What we do, again, we don't partner with everybody, but the people we do partner with, like collateral underwriter, like, yeah, it is a tightrope. What I'm coaching my team members to do is like, you do real adjustments. That's what you do. So like the $20 GLA, yeah, it's going to flag CU all day long. You do what that GLA adjustment should be, whether it's $75, $100, $125. However, go back and make those time adjustments, because Randall, what you're explaining is like, hey, from the appraiser's standpoint, I'm speaking for another appraiser, like, hey, we got it to the finish line. We got all the, we got it to appraised value. What the heck? What do you want? Yeah, but your adjustments are whack. Like you did $1,000 for a bathroom. Like my team, I'm like, dude, $5,000, $7,500. You want a garage, $10,000. The thing that I've found is in the past, we try to keep, and I'm speaking, like when we have like on our sales grid, you've got at the bottom, and this is from the appraisal standpoint, these kind of net and gross adjustments. And even I was trained this way. I'll admit that. You keep it within 15% net, or maybe I'm flip-flop, 15% and 25%. And I'll see appraisals where like, man, they're squeaking through at 14.999 and 24.999. There is no way you did the appropriate adjustment. What you did is you're playing the game. Like you're doing that $20 GLA. And what happens is it kind of like, it just screws up the process at the end, because now you're at the finish line and hey, you had to wait 3 weeks to get the appraisal back. It's jacked. CU doesn't want it. Randall's in the corner because now he has to push back to an arrogant appraiser. And like, here's the thing, maybe it sits in a revision request. So a few things we're trying to do. One, like again, like I'm gonna brag on my team. Like we just don't roll that way. That's not how we do it. Two, we pay dearly for as much information as we can get. So every time we put in a comp, I'm looking at what did all of my peers, even though I might not adjust with them, agree with them, I'm looking at how did my peers submit this comparable sale? Is it a Q4, Q3? What kind of adjustments? What are they even saying it in order to help you guys get under that CU rating threshold? So our team is doing that. We're actually exploring. We know the guys who created that CU underwriter. One of them actually is in the process of going somewhere else, where it would allow us to kind of pre-scrub our reports and still stay 100% compliant, so that before we even, and we're not there yet, but we're in the talks with that, before we even submit it to y'all, we know, because they created that goofy program, where is this sucker going to fire? The third thing I would offer for that is, like, information is critical for us. So, like, if it comes back from like a Randall, it has to come back from the appropriate party. If a realtor calls me and says, hey, explain this, man, I can't, like, I have to get approval because you're not my lender. You're not my client. Now, if an underwriter from like Guild reaches out to us through the appropriate platform and says, hey, this is what it's showing, can you help me understand that? Like, we'll do that. Like, I mean, that's how we are. And we do it in a timely manner just because we have the right people in place to like man that email when it comes out. So even though I might be out in the field, somebody's back at the home office getting this and giving me a heads up. So again, like, we're trying, we're very sensitive to that collateral underwriter, very sensitive to it. And even it might take us a couple times. We're like, hey, I think it should be this, but maybe we missed something. Maybe there's another comparable sale that like we didn't consider, or something that can get that number a little bit lower so we can get the client to that finish line. And sometimes too, we're just protecting our client's the lender. It might just be a bad deal. Maybe the thing was priced wrong, and this could be us not making value will be the best thing for your client because they're overextending themselves and the thing is not worth it.
Absolutely. And in fact, I don't want to make this longer than it is.
Hey, we got 2 hours, and I think as long as you guys are bringing value, everybody's going to hang in there. So
I would actually like, if you guys would like to see collateral underwriter, I have a great example that I just didn't take me long to find one.
Yeah.
I'll show it to you guys. And what we are running into is underwriters that we have to adjust for.
let me just add, this is not a Guild thing. This is an industry behind the scenes. So you guys are going to see something that a lot of people don't even know exists. And it is straight across the board on all mortgage loans. So it's not just even a conventional loan, even though collateral underwrite was created by Fannie Mae. So you'll see Fannie Mae on there, but it's not just for Fannie Mae loans.
Right. And I just want to get you show, like, and this is actually, like I said, it didn't take me long to find. Let me see if you can, let me know if you guys can see my screen.
We can see it.
Awesome. So it didn't take me long. I just went into, just picked a number. So here's one that we're running into. Perfect example is this home.
Can you zoom in?
Can I zoom in? Yeah, let me see if I can figure that thing out.
That's not one of mine. Good.
Chris is sweating it to see if it's one of his.
I was like, good. We don't do Fulton. That's not one of my team. So
if you give me
all you want, Randy.
I don't really know how to zoom in on.
Okay. All right.
Randy, go up, just hit Control, Alt, and plus, and it'll zoom your screen.
You're a genius. Thank you. So
Always.
you say that, but it didn't work.
I'm sorry, Control Shift plus.
Control Shift plus.
One of those buttons.
All right, let's try a Alt Shift, maybe.
Ashley's a hot
Okay.
queen.
Something's happening. Fine. Takes a second.
Or just hit your three little bubbles on the top right-hand side.
Okay, that's probably better. Thank you. I appreciate that. There we go. Thank you. Okay, how about
Yay,
this
thank
now?
you. Yes.
This I came across this almost immediately. Look, like the C
that's
is
crazy.
expecting a 105. And like for this one, I mean, look at the size needed to meet this appraisal.
Okay, hang on, back up. So the column with the brown is the appraisal itself, and the column that says 105 is collateral reviews analysis of the appraisal, correct?
Yes.
Okay, all right, cool. Thank you.
So what you're seeing here is what I'm saying is like the list price for this home is at almost 800,000. So, you know, obviously there was an effort to meet that.
Oh, definitely.
But you're going to see, like, they said, hey, we think because of when it's sold, there's a time adjustment, which is awesome. We should see more of these, I think.
Yeah.
But they're inconsistent. So like you're going to see like $100,000 here, and maybe this is April, so it's probably not changed that much. But collateral underwriter says that, hey, even in the small time of a month or two, the homes in this area are now selling for 24 to 30 grand more. So they missed an adjustment that could have been helpful to meet the value. But, look at acreage. Very, very small. They didn't make a single adjustment to acreage here, which would have hurt this appraisal as far as meeting value. But when we went to ask the appraiser on this one, I can tell you his response was, well, in our market, nobody pays for extra acreage, which I find hard to believe. And that's a very difficult write-up. But he's basically saying that he is giving age adjustments, which are fine. But like this is what you see all the time, and this has actually been flagged. This is a brown warning. Like I can't sell this loan to Fannie Mae without a serious conversation taking place. But you don't have to worry about the numbers, but I'll just fill everybody in to save your time. Because of this $15 square foot adjustment, he only reduced the price of $55,000. But if it had been realistically at 105, the home wouldn't have appraised for $800,000, $750. It would have appraised for $290, $235, and $438. Like
So those weren't good comps.
they
So
were not
that's-
good comps.
Yeah, that's what I would say too. Those are comps are, again, I don't know it, but like comp number one, can you scroll down a second?
Sure.
First off, what is he doing? Or when I look at like that GLA, I wouldn't even consider that.
No, I wouldn't
The
either.
gross living area is so wildly different, but again, I don't know. It might be a super unique property, but I mean, that's more than twice. That's kind of wild.
And this is actually turning out to be an extreme example, but it is an example of what we're seeing. But like when we confront, I'm looking for basically, is there a better way for me to word this to get better responses from the appraisers? Like, how can I tell them like this is unrealistic to myself?
We like to just hear it straight up. I can just speak for our team. What is the issue? Do we miss something? Send it. Just tell me what it is, and I'll tell you like, hey, I don't agree with that, or I do, but like, I always say it's a fool who has no doubts. And if there's something where we missed, yeah, let's make it right. I don't look at it. It's just the more information my team has, the more we can produce that credible report. So it doesn't really make sense digging in your heels. I'll tell you if I can't do it. But yeah, just tell me what is it the GLA? So I'm thinking like when we do get some CU feedback from like a underwriter, obviously we don't get this per se, but they'll allude to, hey, where are these huge flags coming from? And then it just gives us a better idea to be like, hey, maybe these were the best comps, but at least we can address, what the issue is. So,
that's really, I'm going to stop sharing to save people's screens, but that's right. Like we're looking basically, it's hard because we have to come at them in like this at the end of the line. We have no time trying to like make this deal work. And, we're getting stonewalled on our side. So we're kind of caught in the middle trying to like make a sellable loan to Fannie and Freddie.
Yeah.
Yeah. So and I'm just, because we are half loan officers, half realtors on this call, if that happens, remember collateral underwrite, we won't see till we have the appraisal, because it is an analysis of the appraisal and all of the adjustments compared to peer adjustments for the same comps. So, and we can't, there's not like something we can run prior to make sure that we don't have these issues prior to an appraisal being complete. So what, as a lender, can we provide to the realtors so that they understand we're working with the appraiser? These are the problems that we are seeing with the appraisal itself, yes, it made value, but the numbers don't necessarily support it making value based on this assessment of the appraisal. What can we as a lending industry share so that there's transparency with the realtors and with the buyers to have this conversation? I mean, is this like top secret for us? I mean, and mind you guys, this is not something new. It's just a new challenge because appraisers are doing their very best to bring properties into appraised value. I mean, to sales price, right?
Yeah, for sure.
I mean, it's just so, Randy, Stacy, that's a great question for you.
So we're really not supposed to provide any information outside of providing it to the borrower when it comes to the appraisal.
Mhm.
The borrower can provide it to whomever they want to provide after the fact. But as far as our summary reports and our collateral underwrite, that's all part of our file that needs to remain in our file.
Yep.
Okay. All right. So Carrie's question was, would it be helpful if a realtor got an appraisal done prior to the transaction?
Sure.
Yes, just know and understand that when there is a transaction and someone is getting a mortgage or bank loan or whatever, another appraisal is likely going to be required. Well, for a mortgage company, for sure, it would need to be required. So that's not necessarily going to eliminate this problem totally, but it might help you with the pricing of the property and to prepare the buyer for what that gap might be. Does that help? I mean, did I say that right? Does everybody agree with that? Again, that was
And you'd have to know your market too. How fast or your, houses selling. So if you get an appraisal and then you have, the next day 5 houses closed, well, obviously the comps are going to major change.
Yep.
Well, and I think too, yeah, I don't know, Carrie, if that totally eliminates the challenges doing that ahead of time. Stacy, what would you like to add does anybody else have any other questions in regards to that? Okay. Stacy, from an operations standpoint, what do you see and what would you like to add, explain, share?
So really, from my standpoint, I just want to kind of educate you a little bit. Our branches, our loan officers, they're well aware of this, but these are the kind of things I just want to share: the SSR report, the comp part of the collateral underwrite. But when we get an appraisal, am I sharing my screen? Can y'all see that?
No.
Okay. Well,
I have those attachments. Oh, no, now you're sharing.
okay, so this is the second page of the appraisal, which provides the comps. So the one thing that, I'm sorry?
Zoom in.
Now you're asking me to.
Just hit the plus button in your case.
No
No hotkeys needed.
Oh, gotcha. I know stuff, but I don't know the computer very well. You got
Okay,
that?
there you go.
Is that better?
Yes, ma'am. Thank you.
Okay, so the first thing that we're going to look at on an appraisal is normally they're going to go right down to the very bottom and they're going to look at the appraised value and it's as is. And in the past, we were pretty good to just look at that and move on. Unfortunately, with the market the way it's changed, we now have to really look at the comps.
Yep.
And the gross adjustments. And if we look at the gross adjustments, this particular one is 35%, 72%, and 35%. And like Chris was saying earlier, you really, I mean, those, another extreme appraisal, but this is what we're seeing.
My God.
And yeah, I mean, very extreme. So from a lending standpoint, if we look at these adjustments, we know automatically there's going to be a problem.
Oh, yeah.
I mean, there's going to be major problems with this appraisal. So we can no longer just assume, okay, it's a checklist item. We've got the appraisal, it's as is, met appraisal, and we're good to move on. Because we're seeing these kinds of adjustments a lot. I mean,
Wow.
wouldn't you agree, Randy? I mean, we're seeing it quite a bit.
I mean, that's,
So it's honestly, and I don't want to put a damper, it's a high percentage of what we're running into.
Right.
my God. I mean, that's,
And so like Michelle said, when you get the appraisal 3 weeks into the contract, and then we get an appraisal that looks like this, everyone panics. I mean, we panic. We want your deal to close on time. We're looking at this going, our collateral, which is obviously 1/3 of our loan, that needs to be really reviewed, is a major issue. And so then the next thing that we look at when we get the appraisal, these are the summary reports that we get from Fannie and Freddie.
see, I don't get those.
And look at all the warnings on this appraisal. So if the processor, whomever reviews the appraisal before it goes to underwriting, they can look at these findings from Fannie and Freddie, and it tells you what Fannie and Freddie does not like about this appraisal. So they can, start preparing everybody that there is going to be some issues, and this is what it doesn't like. So if you see right here on the Fannie Mae, it gives a collateral underwriting risk of 4 on a scale of 1 to 5. So a 4 is a pretty good indication that's going to be audited when we go to sell the loan to Fannie or Freddie. If it's a 5, it's an automatic audit by Fannie and Freddie.
Yeah.
And we want to sell, although we retain the loans, we want to sell our loans to Fannie and Freddie so that we keep our money moving. But this is going to be a difficult sell based on the current appraisal. So we are going to ask the appraiser to do a little extra work. And again, like Randy was talking about on what he showed you, this appraiser got very mad at us and he was not happy. But we can't move on until we actually have, the information we need. So the next piece is the collateral underwriter, and this is the comp review. And so it tells you, here's the comps that the appraiser used, and here's model comps. And Randy, if I'm saying anything incorrectly, please, correct me.
You're doing great. I'm just laughing at the appraisal.
So it shows where the comps are, and then it goes on to show this information. So this is telling us really, based on collateral underwriter, there are better comps that could be used for the appraisal. Now, like Chris said, there's reasons that the appraiser used what he used, and he did actually come back and he explained everything out in this, and we did get this loan closed.
Good.
But we can't move on until we have all the information we have, because this particular one, the collateral or the SSRs, the stuff from Fannie and Freddie, actually is stated that the appraiser has made different adjustments for these same comps on different appraisals.
On different, yeah.
So
That's a tough one. That's why,
yeah, that's not a fun, so he did one thing on one appraisal, one thing on a different.
Yeah,
and like Michelle said, all this technology is great when we get a property inspection waiver, but it's not so great when it can tell an appraiser how he's used different information on the same comps. So again, this is just something that we really have to overcome. I mean, we're seeing more and more. I mean, 62% of our business now is conventional loans, because that's where the market is. I mean, your first time home buyers or your veterans are not going to pay way over the sales price. And we know everybody's paying over sales price. So we're seeing it more and more. We're seeing appraisers obviously trying to make that value to make everyone happy. And so more and more, we're seeing 4 and 5 ratings from Fannie Mae, which makes it extra work for us, extra work for the appraiser, and then extra turn times that we're not expecting. So we're doing our very best to do everything, but we have to cover, and like Randy said, we have to document why we thought, we think it's okay to use the appraisal to go ahead and close this loan. And then there's sometimes there's just so many defects in the appraisal, we have to get another one.
Yep.
Thank you. So does anybody have any questions in regards to that whole part of the process and what those reports look like and tell us? Or any questions?
I have a question.
Yes.
My question is, I guess to the appraiser here. When we get an appraisal that shows a pending sale on it, and we get it from Bob Fellows, and we have an opportunity for reconsideration of value. If in that appraisal, that pending sale closes during that reconsideration of value, is it acceptable to go back if it's closed during that reconsideration of value and add that in as an additional comp?
So here's what we do. We base value on closed sales. When I looked at that property, that is the effective date. And again, I'll just speak for my firm. I can't speak for every appraiser. But if that is a rock star comp, and that would be, we call it, the money comp, I will circle back with the underwriters and say, hey, here's where we're at. I can't use that comp to put all my weight on it because it didn't sell at the time of that, at the time of the effective date that we at the appraisal. However, if you'd be willing, we could go back out. I could drive by that property, visually put my eyes on it again. And especially if it's just a day or 2 days, I will keep everybody in the loop and we will do a new effective date and then I will use it.
Okay.
Does that make sense? So, that's just the flexibility that we'll do, again, because I have to be 100% compliant and kosher, but I will change the effective date. And on that addendum, I will very clearly say the chain of events that got me to the point where, that we did a different effective date. Not every appraiser will do that. We might charge you a trip fee to do it, but you know what? If that's a money comp and that's right there and it just closed, man, I'm going to use that. That gets me excited.
Yeah. So then the reason for putting on, say, pending sales, is it to show trend? What is the purpose of that?
Twofold. Sometimes our lenders, especially a lot of the big box folks, they want anything and everything. So they're going to say, hey, I want 2 actives. I want 2 pendings. I want it. It might not even be a good one, but you're following whatever their engagement letter was. Sometimes I put it in there because even though I can't put that value on it, again, my whole team, how do you produce a credible report? Well, I'm going to show other homes that are active. So if I have 2 or 3 sales, say I call a property at 450 and I've got at least 1 sale unadjusted, that's 450 because I can't call anything above something. I can't say, hey, the house is worth 500 and none of my comps ever sold for that. The adjusted sales values that I have, I think it adds credibility that, hey, here's a pending sale. And most likely after these adjustments I've applied to this, when it closes, this would be another sale that supports it. But I can't base my primary value on that because we base everything on what's sold. Does that make sense? But I will definitely, I'll use it.
And Randy, what would your take be on that?
Honestly, the pending sale in this market is super helpful because I think the answer to a lot of these things is to use time adjustments because, a home selling 2 months ago is very different than a home selling now in the heyday of June. If you're going to show me, hey, all the homes are $20,000 more than they were in April. Well, if you've got 3 pending sales or something, all supporting that, I think it'd be more helpful than it was in the past to have pending sales coming forward.
Good answer.
What do
Thank
you,
you, guys.
what do you
Yeah.
think, Chris? You think that mindset's okay, or?
Oh, for sure.
Another question that was asked, as an appraiser, is it helpful when the listing agent provides a CMA information on the comps used to come up with the listing price and have them available whenever the appointment is set?
So appraisers are helpful when listening. For sure. Again, I go off of, so I agree with that. So the question, how did basically, the listing agent showing how they priced it? Yes, if they priced it right. What I mean by that, and I've seen this happen, it just helps us understand, because sometimes I'm telling you, we get these deals across and like, I'll look at the guy, or like, I'll hear the guys out on the team and be like, where in that bleep did they get this price from? And it helps us understand, like, is it correct? Was it in error? So a couple of things I'll notice. One is they priced it just straight up GLA. The house is, say it's a 4,500 square foot house, but they're basing GLA on a home that's like 1,500 square foot that's sold in that neighborhood. So it's going to be wildly different. And then they just do a simple math calculation. Well, if this 2,000 square foot home sold for 200 square foot, then this huge one should sell for the same thing. And that's not true. The GLA will go down as the price per GLA will go down as the size of the home increases. So it's not straight up. So that helps us understand that, hey, maybe it just wasn't priced accordingly out of the gate. The other thing I'll mention too, especially like Guild, you guys a lot of times, at least up here, will do like rural properties and stuff. When we're pricing, we're looking at like, hey, we measured 4,200 square foot. These guys have it listed for 51. What are we missing? Please, please, please do not add in guest quarters to the overall GLA. So like, my God, like, I mean, then I'm this big jerk that comes in and says, hey, not only is it worth it, but like the house doesn't even have as much square foot. I will give it value on the sales grid, but from a GLA standpoint, no, don't do that. I can't, that's not, you just can't do that.
Ooh, we see that all the time.
Yeah. And I mean, and it's just a tough conversation because again, I'm not going to leave you guys high and dry. I'll swing back. Even if it's like, we're going to miss, as long as I have approval to do so from the underwriters, like I will communicate that back and say, hey team, we're going to miss. And here's why. It was not priced accordingly because it was not listed accordingly. So sometimes I have to be that reality check. And me, I'm a people pleaser. It sucks for me. I hate doing it, but like, I'd rather have them know. I don't want to just tell you no, and here's why. No, you just need to know that like, hey, here's what it is. An apple's an apple. Like you priced it as an orange. It's not an orange. There you go. That's my analogy.
Love it. So there's a question in the chat, and then I know this question comes up often, is the condition adjustment. Now, number one, my question is, as an appraiser, your knowledge of the comps is limited to the comments in the MLS.
Yes.
And the pictures. So when you're comparing, someone maybe started an HGTV project, didn't finish it, has it on the market, and now that's your subject property, and you're trying to determine condition adjustment or quality adjustment based on descriptions and pictures of the comps compared to your subject. That's difficult, right? And that's not going to fit the perfect little cookie cutter CU algorithms, which means that we're going to have to, I mean, that's just hard. Can you speak to how you guys look at that? I mean, is that a good question for you guys as realtors to understand condition and quality? Okay. I see some nods. So will you address condition and quality?
Yeah. So quality for us, it's a big thing like quality material utilized at time of original construction. Condition. Yeah, that's kind of fun because now we're getting into opinions, and opinions can get kind of wishy-washy. Now there are very clear articulated standards that we follow, but one person's interpretation of that standard can vary. So again, like with my team, the more information we have, the better. So I'm looking at, hey, if I have a comp on the sales grid, and again, we just have the technology to do this, I can see what my peers are submitting. And it's based on the software we use. So I can see, hey, is this a C3, C4? Do 80% of them have a C3? Does one of them have it a C4? And that might be for a few things. One, it can be opinions. Two, it can be, was this a previous sale or something like that? As far as us determining what the condition is, we try to stay as close to possible as what's, as what like USPAP standards are. And that I can go back and say, hey, based on these specific things, it is a C3. And then I will articulate that in the report why it's a C3. The challenge can be is like, yeah, you go into a deal and it's like, hey, it's 80% to the finish line and they fell out of love with this house and they sold it as is. So sometimes on that, if it's something that like it's posing like an immediate threat or like the livability to the house, we always like, I'm always like, I like to put the ball back into like our lenders and our loan, like, hey, how do you guys want to do this deal? Because if it doesn't work for you, I'm not going to submit you a product that's not going to be mutually beneficial. So like, do you want us to do like a cost to cure? Do you want me to appraise it straight up as if it's like 80% there and I'm going to just call it a C4? But no, if I do that, or if I call it a different condition, the product you will receive most likely will have condition adjustments across that sales grid, which in turn will fire most likely a higher CU score. So like, we're willing to work with you, but like on that, because it's going to be hard to say, okay, now out of the 100 comps I have to find the very, very limited few where somebody sold it, like where they fell out of love with the property and they only did 80% of it. So again, we try to follow the industry standards on what we call it. But we're looking at like what our peers are doing. Sometimes I'll see something that's wild. Why did it sell for this much? I'll pick up the phone. I'll call the realtor and I'll put that in there. I'll say, hey, MLS photos, I couldn't figure it out. It takes a little bit more time, but like, whatever.
Now you understand why these appraisals are costing more money because it's taking
Well,
so much more time to do these.
I think there are some appraisers taking advantage.
Okay, well,
So I will say that, but like
your job is harder now.
it is, but again, we'll keep you in the loop along the way, if it's additional complexity and stuff like that.
Erica has a really good question. How much does year built matter with the comps?
Again, this is like
good question.
So here's the thing. Because our office a lot of times will get review reports. Like we just get that. Hey, this
peer review.
Yep. They need a second opinion, and apparently we do a decent job, so they trust us. So we'll go in. My firm, we're not huge on. We put more weight on condition than we do age. I think because it's hard to. It's hard to quantify like, hey, I live in a community. Most houses are between 5 and 8 years old. It's hard for me to say the house that's 6 years old is worth $20,000 more than the house that's 7 years old. It's just hard for me to back that kind of data up. So I'm not going to put it in there. I will say on new construction homes, if it's 1 year old or 2 year old, I might make a condition, I might make an age adjustment, but really I'm making a condition adjustment because I'm saying something that's been previously lived in. If you have a property, for example, that is, what's a good example? House burns out, and it's a neighborhood where like maybe they kept the frame, and like the studs and everything. Technically, say it's a 50-year-old house, but you're comparing it with homes that are 5 years old. But that home has been completely redone. Well, the age on it, kind of like a serial number on a car, is this. That's how old it is. But again, the condition to me holds more weight. So that would be a reason why, like, yeah, there's no way I would do an age adjustment because the home feels like a 5-year-old house because it's been all redone. So in our office and in our firm, we tend to put more weight on the condition than we do the age because we think it's more defendable.
So Stacy's got a slide that she's going to share that she just pulled up that might explain that also. And it's just the property condition slide. And then Chris and Stacy can speak to that, or Randy.
Okay, so what we're also seeing is appraisals coming in. Can everybody see the slide?
Yes, ma'am.
Yes.
Okay. So they're coming in as is. So we see this a lot, but yet the appraiser has taken multiple pictures of problems with the house.
Yeah.
Stress fractures. This appraisal actually has 7 pictures of a
Ugh.
problem with this house. He's made it as is. He did comment on the appraisal that it was normal settlement. Unfortunately, again, this is not something we can sell to our.
Yeah, I was gonna say, now this is a dirty appraisal. There's no way you can sell that.
Yeah,
Can you,
yes,
can you scroll
because-
down just a second? I'm
Scroll
sorry.
down a little more.
This is just me being a dork. Stress fractures. Yeah. Again, I'm an appraiser. I'm not an inspector. I mean, if it's something that's if it's something that like will impact you negatively, like your health, or like something doesn't seem structurally safe, I will call that out and refer that an inspection be done. But again, I'm going to keep our underwriters in the loop. This, to me, this is an inspection report, and I'm not an inspector.
So we actually, when something like this comes into our underwriting department, everybody's looked at it prior to underwriting as is. And so they're thinking you're good to go, but really we are not good to go. We
No.
have to do further inspection on this house to make sure that it is sound, because we've actually had loans kicked back where the appraiser has said as is, but yet taken pictures of problems with the
Yeah.
house.
So it's like they're contradicting. So again,
Right.
and I would even say, based on what I heard you say, the comments were like, hey, this is normal settling. If it's normal, why did you take pictures?
Right.
Yeah, it looks like a CYA to me. A people pleasing appraisal with some CYA in there.
Right.
But what I can say for all of you guys that are on the call that are that work for a mortgage company, we have got to look, what Stacy's saying is look at the appraisal through the eyes of an underwriter.
Yep.
And not just look to see and check the boxes. We're not just looking for, is it as is or subject to, did it make value? Know and understand how to read an appraisal and be prepared for any questions that might come up, because underwriters are super smart, but they're not any smarter than any of us are capable of learning to be. So educate yourself, which is why we're on this call.
Yeah.
Another great question. What does the effective year mean to the CAD tax records?
The effective year, like, what is it?
Like, if you're looking at the, and whoever typed that, would you
Effective year built. So I think the effective year would be, and maybe it might be the CAD. So that might be like, hey, the house was built in 1950, but there were substantial, I can't speak on like the CAD tax records, but like what I have seen is it might be built in 1950, but they're basing it on like, maybe it had substantial remodel work, there were additions, there was all this kind of stuff done, and made it feel more like a 1990 house. Yeah. So the effective year is 1990, but the actual year might be 1950. I know from an appraisal standpoint, we might, there's a spot on there where it'll say the effective years. We might say, hey, the effective years, it might be a 25-year-old house, but it feels like it's a 15-year-old house. Right. So what that does is then it takes it out of a 60-year loan and it says the remaining economic life is 45 years. So it has to do if you're selling a 30-year, and anybody can correct me if I'm wrong, but like our understanding is because you wouldn't do a 30-year loan. If I said, yeah, the effective years, man, this sucker, it's been ridden hard. It feels like it's 55 years old, and it's only 20. Well, you're not going to do a 30-year loan on something that has, remaining 5 economic years. It's been trashed. Does that make sense?
Absolutely. I mean, it does to me.
Does it? Okay.
Does it? Did y'all get that? Yeah.
Okay.
Yep. Y'all have any other questions? Type them in or raise your hand and I'll scroll down here again. Man, you guys have all hung in there for a long time. You must be.
These are good. These are like good questions
good
too.
questions.
Thank you. I didn't know what to expect. So, and by the way, realtors on there, like, you guys have a hard job. Like, so kudos to you. There's no way I would do your job. Oh my God. No way.
Yeah, I'm glad I'm on this side of the.
Yes.
Action
Oh
for
my
sure.
gosh, you guys deal with emotions and
Hey, Michelle, I had a question for you.
Damn.
Earlier, you had spoke about how sometimes an appraisal will get waived for a mortgage loan.
Yeah,
What did you say that the stipulations were for that to happen? Does it
well,
loan amount, or are there other guidelines for that?
no, so whenever we submit the information to the national database, it's the same system that we were looking at that analyzed all those comps. So it will take into consideration the value that was stated for that property, and are there comps in the system that support that value? If there are, then it is very possible that we won't need an appraisal. Now, one thing I was thinking about as we were talking about that, and Randy and Stacy can correct me if I'm wrong, but let's just pretend in this scenario, like we looked at that total cost analysis. Chris, I'm got my hands over your face. That you're making an offer of 250, but you feel pretty certain that the house probably lives around 240. And the buyer is prepared to pay that $10,000 difference in the appraisal gap. So if that's the case, then hang on one second. I'll mute the background. Maybe. Okay. So in that case, then I could run it through the system tied to that property address at 240 if you think that's where the value lives, and the customer is okay with the loan being based on that 240 and writing a check for the difference. And let's just say in that scenario, then the system goes, yeah, you're right. That value sounds fair to us. No appraisal needed. But it is super important that again, it's all about communication, and it's all about the relationships that you had. A couple of things that I wanted to point out that Chris was saying is, number one, appraisers right now are I feel those that I have talked to are very particular about who they're accepting work from, which is why it's so frustrating when you guys are doing a transaction from a big box lender that can't get anybody to pick up the order.
Yeah.
It's because they're so flippin' busy with people that they know, love, and trust, then they have a relationship with, and they feel they can communicate with. Same thing for us. I mean, we work with, through our Mercury, the system that we place most of our orders from, also knows what appraisers are going to communicate in a timely manner, turn the orders in, and answer their phones if we have questions once the appraisal is turned in. So it's a two-way street.
yeah.
It's a two-way street for you guys too. Whenever you're accepting offers on houses, when you're pricing the houses to even list, or communicating with the seller, hey, listen, I know you want 250 for the house, but chances are it's only going to appraise for this amount of money. So let's talk about what those challenges look like when you're selecting a buyer for this transaction. So communication and relationships are key for us to get through all of the uncertainty that we're dealing with today. And then just education. We just can't be too educated right now with all of the changes that are going on. So I can't stress the importance of raising your hand, asking questions, staying in the loop, and just working together, because this is hard. It is really hard. And all of us here do what we do because we truly care about the service that we provide. We care about the families that we're serving, and we care about how what we're doing impacts our industry. So it's just so important right now that we all work together.
Yeah. I would say the one other thing too, just from like kind of behind the curtain, from like an appraisal standpoint, and like we are not the right fit for everyone. But like it is critical, like when you partner with people, like we'll do over 100, like I know what my capacity is. To Michelle's point, some of like these bigger boxes and stuff like that, like, yeah, we took over 100 orders last week, and like we'll produce those. We probably declined, it was a hair under 50 orders. So if I had a capacity, I could have done 150 appraisals easily. But this is what I can do. These are the people I want to partner with. So we'll say no to other people to like partner with folks like you. So just letting you know. And that's just from, because I'd rather do business with somebody I know versus just a big box that's on the East or West Coast. And if this is all I can do, then I'm going to service my kind of A-tier clients. So,
And any of you guys that have been on any of my coaching calls and my sales training, I tell you to do the same thing in your business.
oh, for
Know who you work with really well. And I mean, you have the right to do business with people that you enjoy doing business with, because life's too short to do business any other way. So I appreciate you all being on the call. We'll stay on the call a little bit longer for anybody who has any further questions. And just know that if your question didn't get answered or you think of something later, that's okay. Just shoot me an email. I also have this recorded, so I can send you a link. It's a super long video, so it's going to take a little bit for it to download and then upload. I'll share that link. It'll be on my YouTube channel, michellecastle.com. I've got lots of training on there, lots of coaching videos and all kind of good stuff. Also some of my fun stuff, videos about the community. So if you guys are looking for something to do, that's a great place to go. But also I'll put the link into the private Facebook group. If you are not in the private Facebook group already, message me on Facebook at Michelle Castle and I'll send out an invite. We have to be friends first. So if we're not friends, do a friend request and then I can put you in the group. Anybody else that's not in the group that is in your office that you think would enjoy information, because I'm all about education and making sure you guys have good information. I post a ton of stuff in there that's helpful for you and your business, but it's also an opportunity for you to tell me what you need from us in order to provide the support and education that helps you be better at what you do. So we'll hang around a little bit longer. I just wanted to put that information in there for anybody that wanted to hop off. All right. Well, I'm super glad I'm not a realtor. I'm super glad I'm not an appraiser. I love doing what I do as a loan officer. You guys all probably feel the same way about your jobs. I am glad I'm not an underwriter. I'd get fired if I were.
Yes.
Randy's laughing.
Yeah, good luck, Randy. Good luck, Randy.
There is
You
a
can do
question.
it.
Any tips for finding comps for CMAs? Like, would you go, I'm going to answer this one. I mean, ask this one, but I got another question too. Like, would your go-to search criteria be finding the perfect comps?
So like as far as pricing it, yeah.
Mhm.
So look at what has sold. Like, so when you're looking at that neighborhood, really hone it in. If this is like if it's in something, I'm not talking like, out in the sticks, but if you're in that neighborhood, have those neighborhood boundaries, and then look at look at what has sold within like the last 30 days, honestly. And when and just caution you, like, please don't price something higher than anything that is even sold in that neighborhood. Don't just do that simple math equation with like, well, 2,000 square foot sold at this price and mine's 4,500. Don't overprice it. Like, for something that is even sold, I will not get it to the finish line, period. But I would really focus on 30 days if you can.
There was a question that popped up that Anna asked earlier. It was a great question. We didn't address it. Right now, you do see some for sale by owners. Lord help people. Can't even imagine. But we are seeing some for sale by owner because it's so easy to sell a house, right? Wrong. But if you do know of a for sale by owner, can it be used as a comp, and how would they get that information to the appraiser?
Yes. I mean, that is, I had this has been a while. I had a situation with, not a situation, but just something with Guild where like, it was up here in Sherman, and it had, we thought the house was worth what it was. It was just one of the comps that I was using had sold, and this is before everything was really crazy. It had sold like just over a year ago, so I couldn't use it. So again, we just had that open communication. It was like, hey, I know some other things has sold here. Texas is a non-disclosure state, so I knew there was this money comp that had transferred. Come to find out, Guild had written the loan. So we were able to use that comp because I could visually and disclose that I had viewed those closing documents. So then, yes, I was able to put that in the sales grid, but I can't just go on like, so that was like the perfect situation where like, hey, I know this closed. You guys wrote the loan actually on the one that closed. So it was my money comp. But I have to, and any of my appraisers have to visually see that closing document so we can put that in our work file, and then I can put that in the sales grid. So yes, if you can get that, but it has to be like an official document. It can't be, I mean, we're talking like the closing docs. Does that answer your question?
Yeah,
Okay.
it does. And the other issue that we see is custom homes for a new construction is a little bit harder to comp out because we just are seeing more customs than we are specs right now. So that's another harder property to comp out.
Yep.
So any information that you have on any sales that did not go through the MLS, now you know how to document those.
Yep. Super helpful.
Yeah,
Multifamily again, full
multifamily,
duplex.
there you
Do you
go.
use full duplex sales only? Use sales of half duplexes? Okay, so, oh man, we go back and forth on this. And each different counties each county can be different on how to do this. If it's a half duplex, for example, I'm going to use half duplex comps. Half duplex meaning I can physically own one side of it, and I could, and someone else, a different party, could own the other side. So I'm not going to take two half duplex sales and lump them together to get to one big price and compare that with full duplex sales. So a full duplex would be like when it transfers, both sides transfer. It hasn't been split up, or like when you sell it, the way it is zoned is it's two properties, but it goes as one. I will not, if it's a half duplex and a full duplex, I just don't let them play together on my sales grid. I won't even use them. And single family with same square foot, man, if I have to bracket something, I might use it, but it is a secondary comp completely. So no, very rarely would I use a single family, like a detached single family home with an attached half duplex. I'd rather go out further. And even if I'm trying to bracket something like GLA, or maybe I'm trying to bracket amenity, I might actually go back more than a year just to demonstrate to the underwriter, like, hey, this has been used, and that this isn't like an anomaly in here. These these types of homes do exist. They just haven't transferred in the last 12 years. But I can't use that as my primary comps. Those are all secondary. How much value does a pool? Oh, pool bring to a home in the eye of an appraiser. So this is kind of like a running joke at like in the office, because they'll be like, hey, Green, check out this nice pool. And it's a stinking above ground pool on a manufactured home. And I'm like, you can't do that. So on a $500,000 house, I might make, because the pool right now is probably going to cost you between 70 to 100. I was just talking to gentleman at Foley Pools the other day, and on the low side, and it can go up. We try on something like that not to go more than 10% of what the sales price is of the house or of what the comps are. So if it's a $50,000 or a $500,000 pool, I might go up to $50K. Now recognize that pool probably cost them $100,000 to put in, but the max I would do on that is probably $50,000. And again, that has to come down to like appraiser opinions, but just to coach for you realtors, coach like your the clients you're working with that say, hey, on that appraisal, on that, we look at everything holistically. So just because your pool costs $100,000, we're not going to do a dollar for dollar adjustment. You're probably not going to get that out. And the same thing for like some of these tricked out outbuildings. They might cost $100,000. Concrete is like through the roof. But the most I might do that is like $50,000.
It's funny you bring up pool, because I've been thinking about this a lot lately. The comparison, when I chose to put a pool in last year, one of my reasons for putting the pool in is so my husband would quit talking about selling our house. So I thought, well, I'm just going to put a pool in so we can't afford to sell the house without writing a check. And that would be stupid. Plus I like a pool. So I'm like, I'll just stick a pool in, and then we'll be upside down, or we at least won't get our money back. And of course, that's not been the case because the market's so different. But I think about this with these buyers, they're making decisions right now to write a check, to spend more money to buy that house because they want to, just like I spent more
Yep.
money than I could get for the pool whenever I wrote that check.
Yep.
And so people really are having to make those decisions to spend more money on a house than what the house is going to appraise for, just like I spent more money on that pool than I knew that the house would appraise, that the pool would appraise for. Those are the decisions that we are helping people make right now on a daily basis. It's just that, just because you wrote a check for it doesn't mean that now means that property is worth that amount of money, which is why I think a lot of us are sitting here. If you've been in the business for a long time, your thoughts are, what happens when this customer calls me a year from now or 2 years from now? Am I going to be able to sell the house for what they have in the house, not necessarily what
No.
they ended up praising for? And there might be a difference. There might not. We don't know. I think that that is all the questions coming in. This is the longest call I've ever done. I'm glad you guys all stuck with this and asked all these questions, because I think through the questions we all learned something new. And we're all around if you guys have any follow-up questions that did not get answered or that you think of afterwards. Isn't Chris amazing? I'm telling you, we have great relationships with great partners that help us get these transactions done. We couldn't do it without partnership. And you guys are amazing too. So thank y'all so much.
Michelle.